as investors' attention remains focused on the Federal Reserve and their path to get inflation back to that 2% target. For more on what's ahead for the market, let's welcome in Rob Haworth, U.S. Bank Wealth Management Senior Investment Strategist. Rob, it is good to see you. So, as you heard Julie there, stocks wavering today, Rob. But of course, we had a nice rally. So where do you think, Rob, the market heads kind of near to intermediate term here? Do you want to be putting more money to work at these levels, Rob?
Well, certainly today, this week, it seems a little tough. We've got a lot of questions ahead of that Fed measure of inflation, the Fed's preferred measure of inflation on Friday. But over the longer term, yeah, we think this is a growth-oriented market where the economy is holding up fairly well and there's room for earnings to continue to expand. We've seen analysts start to take up full year 2024 earnings expectations. We're estimating around $244 a share, depending upon which service you look at. And that's probably enough to keep this market in positive territory for the year. Still lots of questions ahead, but we'd be constructive over the long term, maybe a little cautious watching this week as the data unfolds.
Hey, Rob, it's Julie here. So what could be, of all of those questions, which is perhaps the most dangerous for the market, so to speak?
Wow, yeah, well, certainly we have the election coming up. That's probably a question, but probably a couple of months down the road. In the near term, I think the question is, what is the Fed doing? And that's some of what I think we're seeing with the tape today is there's a lot of questions from the market about Fed speakers and how likely is the Fed to start to cut rates. We're now seeing that maybe it's not an event until November or December, and maybe we get one this year instead of multiple. So I think that those Fed speakers remain highly important, and how that inflation data evolves is where the market is going to be really focused.
One issue, Rob, I want to get your take on this, because Ed Yardeni, the strategist and economist, in his note to his clients this morning, Rob, he really zoned in on geopolitical conflict and what's front and center there, really. And of course, Russia, Ukraine, Rob, and China, Taiwan, Israel, Hamas. How do you think about that as a strategist in terms of just kind of economic and policy implications?
No, great point. It's something where we really haven't seen much of a market impact yet, but where for our clients, we're thinking about it as really being the epicenter in commodity markets. Commodity markets in general are in shorter supply right now, whether we think about oil, metals. We're even seeing some supply disappointments when it comes to the U.S. grain inventories. So we've actually thought that we want to own some inflation protection in portfolios against those geopolitical risks. And we're thinking about broadly diversified commodity exposure there.
At the same time, it's interesting because, obviously those are also a risk, as you said, to the upside for inflation. When you were talking about what's going to happen with the Federal Reserve this year, at this point, does it matter to equity markets if there's a cut or not? In other words, is it almost agnostic to there being a cut?
I think it depends on which sector. So the agnostic part is probably the artificial intelligence and growth part of the market that we're seeing just natural growth rates with or without the Fed cutting rates. But we've seen smaller companies, interest rate sensitive companies, thinking utilities and real estate, have struggled with higher rates for longer. That could be the challenging part of the market, is if they don't get Fed rate cuts, is there some further pressure on those multiples as we look over the rest of the year?
And Rob, just sticking with the Fed, Jay Powell's favorite key inflation metric, PCE, Rob, we're going to get that on Friday. What do you expect? How important do you think that is to the market?
I think it is fairly important. I mean, the surprises would be outside if we overshoot last month's reading or undershoot last month's reading. Right now, I think consensus is about a 0.3% increase, about 2.8% year over year. We don't have anything to tell us to think differently than that, but we'd be worried if there was a significant overshoot or undershoot, and that's where the market would really start to react.
Are there any other places in the market that you think it's good to be right? I mean, would you be in artificial intelligence, for example, as well as you mentioned some of those commodities, but AI on the other hand, is that a good place to be?
Well, some of those names have certainly seen a surge in the last week and the last couple of days. So it's tough to buy at these levels. But in the longer term, yes, we think that's a place that investors need to have some money put invested just to be able to benefit from what looks to be longer term productivity growth, but is right now at least an epicenter of corporate investment.
How about fixed income investors, Rob? Listen right now, if you're looking for advice, what's your guidance?
Yep, we're really interested in looking at credit, both in the municipal space and in the corporate space. We think there's room to run here, even though you're seeing valuations are on the rich side. That this solid economic growth scenario we have for the U.S. economy is giving companies earnings room to run and earnings and some room to kind of continue to make those payments. So we think there's room for investors to kind of capture that extra yield, whether it's high yield corporate bonds, AAA collateralized loan obligations, and in the municipal bond space, we'd look to the lower quality end of the market because we think there's still kind of low distress there and room for people to capture those yields.
All right, Rob, good to see you. Thanks a lot.
Thank you very much.